Hey everyone, welcome back to the channel. I have the absolute pleasure to welcome back after 2 years, almost 2 years, I can't believe it, Daniel Neziol and Chris Heeks from BMO, the guys that manage or behind the scenes at BMO ETFs. Guys, such a pleasure to see you again. How's it going?
So good to be back on the channel. Thanks for having us, Adrian.
Hey,
Yeah, I can't believe 2022 was 2 years ago, just about. So, anyways, good to be
Yeah,
back.
so much has changed, we were saying, in
yeah,
the
and I got a
market.
special surprise for you guys. I didn't share this with you beforehand because I want your live reaction. Look at this picture. This is us three. 2 year, a couple of years ago, filming, talking about the BMO covered calls ETFs. First thing I noticed is, of course, this was when we were complete noobs. First of all, we misspelled Danielle's name,
It's
which is
okay.
terrible, and I apologize for that. But check out the background. I mean, you have this was during the COVID height, right? So I think Chris, you're at home. I'm in
Definitely a home
Panama here.
office. Yes, sir.
Yeah, I'm in Panama. This is actually when, we were at an Airbnb and, I had everything was moving so fast with the channel. Everyone was contacting me. I want to come on your channel. It was insane. It all happened while I was in Panama. You could see I'm like pasty white. Didn't even get a suntan because I barely went outside. And now I live here. So pretty crazy stuff here. So yeah, it's fun to talk to you guys again. So, obviously my channel is all about income investing, covered call ETFs. BMO still number one in terms of AUM. They're very trusted, big banks. So we're gonna do a catch up on BMO, the covered call ETFs, because you do have a pretty innovative and exciting new product that recently came out. I've already covered it on a channel, but we'll talk about it. The all-in-one, you guys, I love the all-in-one. So let's just start very easy. So covered call ETFs in Canada, especially in the last, since we spoke even, they've exploded, right? There's so many new launches, new products, sector specific, broad based, you name it now. They're even single stocks, right? So why do you guys think there's such a big interest, or why do you think this market has really exploded recently?
Well, Adrian, we just said it's been 2 years since we talked last,
Yeah.
and so much has changed in the market. So last time we talked, interest rates were probably close to zero.
Yeah.
Okay, so that's completely changed. Inflation, we were maybe just seeing the early glimpses of inflation, but everyone was saying it was going to be transitory and it wouldn't last. And now here we are, and we can see that inflation, in fact, has lasted, and it's been very, very high and impacting Canadians and us across the board. Our mortgage payments are us at the gas pumps or grocery bills, but also in investment portfolios. So I think a lot of investors were really looking to capture higher yields, well, income investors at least, looking to get higher yields to compete with those higher rates that now we're seeing on GICs and in the market, and higher yields to combat inflation in their portfolio, and really looking to ETFs to capture it with those option strategies in a tax efficient way, which has kind of always been the case, but to keep up with the changes in the market. But I also think investors are getting smarter, and they're figuring out how they can use these ETFs as building blocks to complete an entire diversified portfolio. So instead of just thinking about yield, now they're thinking about, well, let's build an entire portfolio where I'm getting global diversification across regions, I'm getting industry diversification across sectors, and all those things are available in different types of cover call ETFs. So it's an exciting time for income investors, especially here in Canada. They have so much to choose from, and that's why it's great to have a channel like this where we can provide some education and insight on particular products that are out there.
Yeah, fair enough. Anything to add, Chris, to that?
Well, no, just to reemphasize, yeah, just how, not only has the growth been there, I think because, like Danielle's saying, that ability to deliver income, in an environment with high inflation, but cover calls have also gone mainstream. And we've seen that north of the border, also south of the border. And, just like ETFs in general, like greater awareness tends to lead to greater adoption, greater
Yeah.
choice for the investor, which is all a good thing. So we've just, really just kind of seen a really nice wave of interest into the strategies, and a lot of investors finding, that they can use them in their portfolios to, get the outcome that they want, higher income and some equity growth as well.
Yeah, I like what you said that they're going mainstream. I would have never imagined this when I started a few years ago. I mean, I've never heard of these things. I kind of stumbled on them by accident and had to experiment with them and how they work. And it's actually really in 2020, the crash, where I'm like, okay, these are great for me because they still pay the income despite the volatility. So, that's where that lower volatility advantage comes in. There's tax efficiency, like Danielle said. But yeah, mainstream, I mean, it is pretty much going mainstream. I see people, even non-income investors, more like growth investors, add them tactically a little bit just to get a bit more yield, less volatility, and you don't necessarily have to go all in on them like I personally do. So there's different ways of using them, which is very interesting. And speaking of before, all in one, I love, diversified, broad based options. It's so easy, so simple, just like an index ETF, right? Now we have the same type of thing coming out in the covered call space in Canada. And speaking of, you guys have recently launched your own, all-in-one covered call ETF, we could say, and it's ZWQT. I'll just share the screen real quick here, just in case audience members don't know. So let's talk a little bit about this ETF. So ZWQT, this is the BMO Global Enhanced Income Fund ETF series. So basically what it is, it's an ETF that holds other ETFs, primarily, a good selection of BMO covered call ETFs. You have the ZWG, which is global dividend stocks, the US one, the Canada one, the Europe one. So you got your four big regions. You also have some more sector specific ones like technology and the Canadian six banks and energy. So my question to you, and this is maybe, for either one of you, how did you guys decide which ETFs to include, which ones to exclude? Because they're not all in there, right? And I've been getting some questions from the audience like, okay, why is, for example, the utilities one not in there? And how did you guys come up with the percentages? How did you come up with the strategy with this all-in-one ETF?
Yeah, I mean, I'll start off and I'll just say, first of all, music to our ears that you love the all-in-one, because that's what we're trying to do, is just simplify solutions for investors.
Yeah.
When you look at kind of over the years, we've just been kind of increasing the options, no pun intended, increasing the selection of covered call strategies. A lot of what we do is give clients tools so they can build the portfolio that speaks to them. But then there's some clients who say, this is great, but I'd rather you do a little bit more of it for me in terms of putting it into an all-in-one solution. And that's where we thought, okay, it made sense, especially with our lineup of individual covered call ETFs. Let's do an all-in-one solution. So if an investor just wants to put on kind of global equity exposure to a high level, but get the benefits of covered call, the income, the tax efficiency, et cetera, then they could do it in a one-ticket solution. So that's what we're thinking. For us, what really made sense to build the core of this portfolio is the high dividend covered call suite. So like you said, the ZWG, the ZWH, ZWC, et cetera. Those portfolios in themselves are fairly well diversified across sector.
Yeah.
They're tilted towards higher income stocks, like higher dividend stocks. And we're always looking for blue chip, sustainably paying stocks into there. But they're diversified by name and by sector across each region. So that created a great backbone against which to structure the product. But then what we also added is, again, that ability to add some sector calls in there. And given that we're BMO, we've got an asset allocation team, we can draw on some of their calls in terms of what sectors look a little bit more attractive at any given time. So there is a little bit of a tactical component to this as well. When you asked about utilities at ZWU, it's a great ETF. It's yielding a lot right now. Utilities have been punished a little bit, in the last couple of months.
Yeah.
We actually were in that ETF in the Global Enhanced. We did have a ZWU early in the year, but we rotated out of it. And like you kind of highlighted, the three sectors that work very well in this portfolio, technology. And I liked your comment on covered call doesn't just have to be income, because ZWT, our technology ETF, is up about 50% this year. So that's given you more than just income. That's given you a lot of growth as well. Technology also really complements like traditional dividend payers, right? Like, a lot of technology companies don't even pay a dividend.
Right.
So it's a great one to include in this portfolio, especially when we're building it around dividends. Technology, energy is in there. And, our asset allocation is constructive and continues to be constructive on energy. That's been a good call the last few months. And then Canadian banks, one where certainly been volatile and they've been kind of, a little bit under pressure, but there's such a great long-term performance with Canadian banks, and they still have great competitive positioning, well capitalized. So we think that'll be a good long-term holding for the fund as well. So we build the portfolio around the high dividend suite, and then we build it out with additional sectors, and we can be tactical with those sectors to try and get the most we can in any market environment.
And this is why I love having the actual fund managers on to explain and go. Now it makes a lot more sense to me, and I'm sure for my audience members. And just a quick question there, continuing with ZWQT, are you flexible down the line or in the future? For example, you said rotate out of ZWU. Do you have the possibility or the can you put it back in and then swap something else? Like, are you allowed to make tactical changes in the future for ZWQT? Is it something you're consistently monitoring to make, to try and capture, like you said, tactically the best growth potential over time?
Yeah, no, yeah, absolutely. So we look at
Okay.
it kind of once a month at a minimum, and just to say, are we happy with our exposures? Can we make a change? Our asset allocation team makes it once a month, and they actually publish publicly, and what they think in terms of their views, what kind of equities they like, different regions, different styles, different sectors. So they're publishing that once a month, and like other investors like them, we can use that to put on some tilts into the portfolio. Not saying it's a high turnover portfolio. Again, the core is like the backbone. It's pretty solid and sturdy. Doesn't change too much. But
Okay.
around the edges, like I said, we've added to energy, to technology this year. We can do that to try and enhance return even a little bit further.
Personally, I think it's a great strategy. I think it makes complete sense. You mentioned ZWT, the technology covered call ETF, and you mentioned the great performance. I have to say, just before the call, I actually compared it to some of your covered call technology ETF competitors, and it's has the best performance. So one thing I've been trying to say more and more on my channel, because this is the income channel, it's the yield channel. Yield doesn't mean return. It's two completely different things, right? The yield is part of the return, but total return is, the yield plus the stock price appreciation. So I have to ask you, so it outperformed its competitors, ZWT specifically. Why do you think that? What do you attribute that to? Is it less covered calls? Is it the stock picking? What do you think made it go over the top?
Manager skill, of course, right?
Managers, of course, of course.
But we've got a pretty simple methodology with that one. But sometimes being simple and just having making reasonable decisions can work out very well. With that one, we did a couple things. Is we didn't want to just do the NASDAQ because the NASDAQ has some non-tech elements into it, and it's got some biotech, it's got Costco, Pepsi. Yeah. So although NASDAQ kind of trades like tech, we wanted to just focus on tech. So we take the companies out of the NASDAQ that are tech focused. We also look to companies that are not in the technology index and add those to the portfolio. So like, for example, Amazon is a consumer discretionary. You might have some tech funds that don't own it. We want to own it. Google or Alphabet is the same thing. It's in the communication services. We want to own it in a tech fund. We think it should be in a tech fund. And then what we do is we own 30 names, and we're just looking for the top, kind of the largest 30 names in the universe that are technology-oriented companies. So very pure play towards tech. Mm-hmm. And that focus on the top 30, I think, keeps you out of some trouble with regards to maybe some very small or speculative ones. But it also, like this year, those large cap ones, being in those companies really kept you in the mix. Yeah. So yeah, I mean, versus our covered call competitors, even versus our competitors who don't have covered calls, and technology is up a lot this year. This fund has done exceptionally well. I think it's just kind of a straightforward rules-based methodology that can serve it well.
It has,
because it's also the call writing too, right? We're not writing too close to the money, and that's, I think, something we're going to get into later. But keeping that growth, especially in a sector that got completely hammered last year. If we were writing too close to the money and just focusing on yield, that huge growth that all those tech names had this year, the investor would have missed out on all of that growth. So really just about that balancing act between yield and growth, I think is an important one to highlight. And Chris, you and your team do a great job at managing that.
Yeah, it is very important, right? The cover call strategies is very important because the more, I say the word aggressive, but you know what I mean? Like you said, more closer at the money, more coverage. If on something that will grow significantly, you're really capping your upside. So that's where the less aggressive covered call strategy shines. And just correct me if I'm wrong, we're still the same methodology, typically out of the money calls on up to 50% of the portfolio. It's the same thing for ZW, for the technology one, right?
Yeah, same thing. So okay, about 50% cover about half the portfolio, and we'll be out of the money, trying to collect, call it 4 or 5% in income from the tech names. And if the market's saying, hey, you could be way out of the money and get that yield, we're happy with that. And like Danielle said, the benefit for the investor is if, and they did, those technology companies rally a lot, it's more upside participation and equity growth.
You capture more of it. Yeah, makes sense. Yep. Okay, cool.
It's
now
pretty incredible. So I just will say too, because
sure.
I think you guys are really flying under the radar of it this year. It's pretty incredible. It is pretty much kept up with the NASDAQ almost this year. And it's a cover call fund. And that's like, I think that's something that's almost unheard of, to get that kind of performance and then get a yield that's, I don't know, the yield about 4 times what the NASDAQ would be yielding if you just owned it. So that's, I think, pretty incredible to showcase to an investor this is available.
Yeah, definitely very good, impressive performance in the last year for sure. You guys talked a little bit about the NASDAQ index. I'm just curious, you have a lot of, especially recently, a lot of index-based covered call ETFs that have been coming out, literally S&P 500 with covered calls, NASDAQ with covered calls. You guys don't have any of those, but you do have the Dow Jones one, ZWA. So I'm just curious, why do you have that one, but you don't have the NASDAQ or the S&P 500 one? Is it on purpose? Do you feel better with the US high dividend one, or is it something you guys are thinking about maybe launching? I know you can't speak about future launches, but what's your mindset behind that?
Yeah, so I think it just shows the evolution of our suite as an ETF provider, but also cover call ETF provider over the past decade plus years that we've been doing this. So when we first brought cover call strategies to market, we were looking at an index. We were looking at U.S. equities. That's where kind of the demand was growing a little bit, but there was also no education around cover calls at all. So our sales team were going out mostly talking to investment advisors, and writing on something like a U.S. equity index was kind of an easy way to start, I guess, for the industry, but also in an education perspective. But as it evolved and cover call strategies got more popular, we were noticing huge interest from income-oriented investors and looking for those tax-efficient methods, especially in such a low-rate environment that we saw around the time that these were launched. So we pivoted a bit and started launching high dividend cover call strategies to really juice that tax-efficient yield for the investor, giving them that dividend on those high dividend companies, and then getting that option premium in there as well. And then doing some regional focuses, so a Canadian version of that, a US version, and a European version. And that was widely successful for us. And I think that really worked well and really resonated with income-oriented investors to get their yield not only from that option premium, but the dividend as well. And then as we kind of evolve, as the markets evolve and investors get more educated on the types of cover call strategies, they're more comfortable adding these to their portfolio. Now you're seeing other strategies come into play, other providers looking maybe to leverage the things like the NASDAQ. I guess investors are looking at tech and wanting yield as well. So you're seeing those types of funds come to market to serve different groups. But and we're also, we brought ZWT to market because we did see that there was a gap where income investors were missing out a little bit on tech names. And so we tried to fill that gap with ZWT. So really, we're really trying to react to what investors want. And that kind of evolved this way that we focus mostly on the high dividend and then sector focuses along the way as well.
Interesting. Okay. Yeah, it makes sense to me. And when it comes to when it comes to cover call ETFs, first of all, across all your suite, they're monthly payouts. So obviously the viewers are going to be interested in the payouts. How much yield could I get? I mean, let's be honest, people are investing in these for that nice monthly income growth as well. And when it comes to I just looked at all of them 30 minutes ago. It's not, typically it's the same monthly distribution, but they could go up, they could go down, from year to year, month to month. So I just want to share, and we'll go through a couple of them if you don't mind. First of all, this is the ZWT technology ETF, the one that we've been talking about that has had a stellar performance. You see here in the last year, 45% up. And I'm very impressed because I just checked the NASDAQ 100 and it's higher than the NASDAQ 100. So that's very impressive. So when it comes to, the monthly income, you have ZWU, that's the utilities one. ZWB is the covered call, the 6 banks, very, very big, very, very popular. And you also have ZWH. These ones have kind of slightly recently lowered their monthly distribution. Then you have the Europe one, which is part of the ZWQT, right? It's one of the core ones, regional. You have ZWG, the global one, which is a #1 position. And then you have ZWA. These have all slightly increased recently. So why don't you tell me a little bit, basically, what can we expect as in terms of monthly distributions? What determines these monthly distributions? Obviously, we know covered call income depends on the volatility of the stock. So are you guys checking this every month, making a decision? How do you decide the monthly distribution going forward?
Yeah, so great question, and yeah, we get that question, not a lot, but often. Really, there's two components to the amount of income we pull in, right? For each strategy, there's going to be a dividend component,
Yeah.
right, the dividend yield, and then there's going to be the option yield component. And then against that, fees would be deducted, so our average fee is 65 basis points management fee, and that'll be deducted, and that would be the net yield. And really what we're trying to do with our distribution policy for covered call ETFs, but really for any ETF in general, is we're just trying to pay out what we're earning. We're not trying to pay out more,
Right.
and we're not trying to pay out less. You actually can't pay out less. You have to pay out what you earn. That's a fund rule. But kind of importantly is we don't want to pay out more than what we're earning, because that can lead the price to go down. And what we really want to keep, a stable price level, so these can be really sustainable going forward. And so that's our focus around that. When you look at those two components, the dividend and the option premium, the dividends usually are relatively stable. If you invest in good companies, which we obviously seek to do, typically that'll kind of tick up a little bit over time. Canadian banks are a great example and really well known for dividend growth.
Yeah.
So you'll tend to see over time the distribution will get kicked up a little bit from the dividend yield. That option yield piece is the little more tricky piece where, the prices of what we get from options, it depends on what the market's paying. And we don't really look to adjust on a month by month basis or anything like that.
Okay.
But usually about quarterly, we'll take a look and we'll say, okay, what's the option market been paying us on average in the last 3 months, smooth it out, and then just try to adjust our distribution yields to, again, that like net income that the fund is earning. So look at okay, as we're going to reset for another quarter, what's our dividend yield, what's our option yield, take off the fees, and where should we be? Do we need to make a little bit of an adjustment up or down? So what you do find with our products is there's a little bit of adjusting up or down. I'd say overall it's very smooth over time. Most of them have a little bit of an upward tick over time. Like banks, for example, has gone up over the last 10 years. As banks have increased their dividend over time. But you do see a little bit of that adjusting because again, we just want to make sure we're paying out what we're earning. Keep that investor capital base strong, so kind of continue to deliver income and growth going forward.
Yeah, and that's very important for a lot of investors, especially older investors, retirees. And I especially like, the key thing that I noticed, as you said, we don't want to pay out more than what we earn. So that's very important, right? So we don't want, it's typically referred to as grinding. You don't want to grind the ETF down. So I think that's very important for a lot of people to hear that, especially you want that consistency. And so it is two components, right? You got the dividend yield, which, on blue chip quality stocks, it's very rare, but possible that, they don't really reduce their dividend or cut them. This is why, when people look at these ETFs and they say, oh, the dividend was increased, the dividend was cut, I don't really see it that way. I think of these products more like they could have fluctuating monthly distributions because option premiums, which is based on volatility, could change. Have I said anything that you don't agree with right there?
No, exactly, 100%. No, that's exactly how we're looking at it. So, yeah, I mean, we don't want to be over distributing. We don't want to grind on the price. That'll help the client out, and so I think we really do have a focus on that. So, I don't know if we're going to talk. Like our yields aren't necessarily the highest out there. We're in the 6 to 8% range, kind of right now on average.
It's coming.
Okay, that's coming. We'll get into that, but okay, we'll come back to that.
I'm going to jump in for a sec. Just a reminder to investors who are looking at these distributions monthly, and they do see there's a drop, and they think, well, I think volatility is still high, so why is there a drop here? But
Great
remember,
point.
Volatility is different from sector to sector. It's different from stock to stock. If we just look at the VIX, that's a good indicator where volatility is. But how Chris is managing this options portfolio, they're looking at the volatility of that specific underlying stock. And so there can be some variances, and that's what's really reflected when you see a distribution go down.
The options market, from what I've, after speaking to a lot of fund managers, completely different in Canada, not as big, not as liquid, not as, and you guys are writing, on the individual stocks, you're not writing index options as well. So the VIX is really, the volatility of the S&P 500. It doesn't necessarily correlate to the 6 banks, right? Or the
Exactly.
ZWU or
Yep.
the utility stock. So I totally understand what you're saying. It's good, it's a great point, Danielle, that you bring, because you can't just look at the VIX. It's, on the Canadian stocks could be a bit different. Different market, different options market as well, which is in Montreal. The options market is in Montreal, my hometown, by the way, in Canada. So, okay, so now we have 3 questions that have been the most voted by the audience members. So whenever I have, some big shots coming on the channel like you guys, I always ask the audience, what are the top questions you want me to ask? So let's go through the top 3. And I have to say that, these are really the questions I have as well, especially this one. This one's really, for me, but also the audience as well. Where are the leveraged BMO covered call ETFs? I mean, you guys are, you work for a bank. Isn't there like a money printer in the back? Isn't it free or something? So
where is
Yeah,
that money printer? I'd love to.
where is it?
Let us know what floor that money printer is on, because I'd happily do some due diligence.
Yeah,
We're not, we're not against leverage per se, but we just think, investor has, consider the impacts of leverage. And our reservation with cover calls is, in particular for the leverages. When you think of a cover call, and how it performs in different market environments. If stocks are down, it'll tend to outperform because you've collected the income. Stocks are sideways, it'll tend to outperform because you collected the income if you're selling out of the money options. But if stocks really go up, right, it'll tend to underperform. So in some market environments, there's a cap with covered calls. There could be a cap, and that's why we only cover half the portfolio. But when you're levering, the lever, what we're worried about is, can you get the benefit of leverage on the upside if there's a cap in place? So what we don't want to see is, okay, you put leverage on a covered call portfolio, you're still subject to the cap, so you don't get the benefit of leverage on the upside, but you'll still have leverage on the downside. So that's our reservation. I wouldn't say we'll never do it, but I think leverage, you want to make sure you're getting paid on the upside as well as the downside. So that's my kind of word of warning and why we haven't done it so far. And the other thing I think just for investors, to consider, I think for some of the providers that are doing levered covered calls, let's say a covered call was yielding 8% and you do 1.25, so now you're yielding 10. But be mindful of the added costs of leverage and whether those are disclosed when you just look at the yield, because obviously leverage costs a lot of money now. Even for 25% leverage, if the cost of borrowing is 6% now, that's an added, 1.5%. So again, another reason we might say in this environment where money is actually pretty expensive, much more expensive, does leverage make sense?
Yeah, that's true. And a lot of them have been coming out, 25% leverage is pretty much the most common one. And you're right, the leverage cost, you won't see that in you will see it in the MER. You won't see it in the management fee. And, it is borrowing costs, right? For sure. It's going to be, yes, you're getting more yield, you're getting more growth potential, but you're going to get 25% more volatility. For a buy and hold income investor like myself, completely fine with it, but I totally understand the reasons why. And I'm just, because a lot of these providers, so here's maybe a bit of a harder question. So what you're saying, I completely agree with. It's the truth and everything. Why not give investors the choice, right? A lot of these providers are doing something that I find is really smart. They have a non-leveraged version. The leverage version just holds the other ETF, the non-leveraged one, with 25% leverage. So investors have the choice. Is that something that you still don't want to do? I mean, why not give investors the choice would be my question.
Well, yeah, no, it's good. We do want to give investors the choice. Like for example, one thing comes to mind is we launched low volatility ETFs. Sort of take you a little bit off topic, not income focused, but low volatility, and we used a low beta approach. And they'll say, well, okay, you launched a low beta. Why don't you give me some choice and launch a high beta product as well? Well, we're launching low beta because we think this is a way that you could potentially outperform the market and lower your risk level. There's a sharp ratio benefit improvement to low vol. And, in the case that on the other end, high beta stocks, well, they tend to disappoint over time. So we didn't launch a high beta because even if someone might want it, we said, well, this might not give the result that people want over time. And I think that goes back to like one thing we're really cognizant of is we do not want to have a client have a bad experience in one of our products. We want it to be clear and transparent on what they're going to get. Again, we don't want to have the price grind. We don't want to have an unanticipated experience with leverage where perhaps they don't have the upside they think they're going to have, but they have the downside they don't want. So again, we want to deliver a really good client experience. We want to be, sustainable here for the long term. We're not just in it for this year or next year. We're in it for the long term. And so, that's the reason why, we're focusing on the products that we focus on.
Yeah.
Masterfully handled. Danielle, I don't know if you want to add anything.
Well, I was just going to say, if you look at the strategies we have had high conviction, for example, our high dividend cover call approach and the way we go about writing our calls, those have over a 10-year track record. You can look how they performed in different market cycles. We feel that they've kind of stood the test of time in that way. Investors are still looking to these strategies. And so these are the types of strategies, like to Chris's point, we want to bring to market something really sustainable that will hold through all different types of market cycles. And until we have that level of conviction on a strategy, you won't see us do it until we do. So we're always looking and watching how these strategies work and monitoring, but there's a lot that goes into listing an ETF from our perspective, a lot of research, a lot of due diligence, and we don't want to rush the process. That's kind of how we stand as a firm here, BMO.
Makes sense. And you guys, Chris, you mentioned the low volatility ones. I have to say this because a lot of my audience members have actually mentioned them to me. So, I'm in the search, you just do low volatility, you'll see them. A lot of people have told me, Adrian, check out ZLB. The performance is really good and like, lower volatility, which means more stable. So I just want to point out to the audience members that if you're interested in checking them out, just do a search low volatility. I personally haven't researched them that much. I do remember looking at the ZLB performance at one point and being very impressed, I have to say. So it seems like you guys have a Canadian one, international one, emerging market one, probably US. There's the US one. So just wanted to point that out.
If you ever want us back on the show to talk low vol.
Oh, you guys have come back anytime. You guys are more than welcome. I mean, for sure. Yeah, I mean, my audience ranges from, younger investors to, 30, 40-year-olds like myself. And then I have retirees in their 60s and some are even older than that. So I always try to tell people, look, investing is not black and white, which is the best. You got to figure out which is the best for your personal situation. Just because I'm an income investor, I have nothing against growth investing or dividend investing as well. So just have to point that out to the audience and that's perfect. We'll have you guys back. We'll talk about those ones as well. Okay. And we'll do a little bit more research on them before so I could ask some questions. So second most voted question now. And we kind of talked about this. You guys kind of touched already on a few of these points. Why do BMO covered call ETFs seems to have lower yields than most of the competition? So this was a very highly voted question.
Yeah, we're focused on that 6 to 8% yield for most of our covered call ETFs. I think us as a team have figured out that's kind of a nice sweet spot for keeping that yield sustainable and manageable. Like I mentioned, over specific market cycles, kind of standing the test of time. So we're not using leverage right now. We're not writing at the money calls. Those are two big levers that an ETF provider can pull to really juice a yield more. And we're not using those tactics at this time. So our focus really is just keeping that yield sustainable, keeping it reasonable. We like to say it's not too greedy approach. We still want to offer growth on the back half of the portfolio for that investor. But just keeping it really sustainable for these investors so they can hold that ETF over the long term and know exactly what to expect from it.
Makes sense. It makes sense.
Yeah, and I think it's just being, again, I'll go back to that point. We don't want to, we want to keep price stability on the NAV of the ETF. And, when I think about it, and there's nothing wrong with, say, a higher yielding product, but I think you probably should understand that if it's yielding 12, 15%, there's probably a good chance that price return is going to be negative over time. Because, take a step back and think about what are we doing here? We're investing in equities. Yeah. We're turning some of the capital return into income. But, equities on average over time, over a long period of time, they're somewhere around 8% return. Maybe tech equities would do a little bit better over time, 9-10% return over time. That's kind of the neighborhood we're in. So if we're distributing out 6 to 8%, we're in that neighborhood or slightly below long-term equity returns. So we think that's going to be, a good place to be to keep that price level up over time and slightly grow over time as well. But if you're yielding 15%, that's like starting the 100 meter race, like 25 meters behind. It's just going to be very tough to keep up. So that's that's our focus, and we think that'll lead to better outcomes over time.
Okay, fair enough. And yeah, I agree. I mean, I tell my audience members all the time, you got to understand the fund manager's covered call strategy because they're different, right? One that's 12 versus 8 versus 15. You got to understand how their chances are they're writing more covered calls on a higher percentage of the portfolio, probably, you know, closer to at the money or at the money. So you're going to get that high, really nice higher yield, which a lot of people get attracted to, but you are giving up more upside. That is because if you look at the stocks, it's all the same stocks pretty much in all these product stocks or indices or whatever. So like you said, if you're making an average at 8%, you know, everyone's making that average. So you got to be mindful of the covered call strategy, which, by the way, you go to any one of your website, which you recently revamped in the last I think 6 months or so. You could find a document there that explains from A to Z the BMO covered call strategy. I've shown it several times. I've read it several times on the channel. And people could go and check out your covered call strategy there. So final question, I'm going to let you guys go. I mean, I could talk to you forever, but I know you guys are busy. You want to get off. So last question, most voted question from the audience. Why should investors choose BMO covered call ETFs over the competition?
I love that this is the most voted question because it shows that
By far, by the way.
I love that because it shows your audience is looking, doing the proper due diligence, and why should I go to one firm versus the other? That's an important question, definitely, to ask as you look to investing in ETFs. So just to start that answer, I'd say for sure the tenure and expertise of our portfolio management team. Chris and a lot of his teammates have been on the team for over 10 years, and I think we're talking about this before we started the show. I think that's the longest tenure on the street here. Just that expertise goes so far in terms of value, especially when you're looking at someone who's managing an options portfolio for you. They're not just tracking an index. It's really important. And then the track record of all those cover call ETFs that we've had, it's proven. I know past performance doesn't indicate future results, but you can get a sense of the experience of that ETF through different market cycles and different times. And I think that's really powerful versus entering an ETF that's newly listed. You really have no idea how it's going to react to different market environments. I think the assets that we've generated over I think it's been 12 years or longer since we've had cover call strategies is another huge point to make. So not only are direct investors looking at our cover call strategies, but we have a lot of institutional investors and investment advisors also continuing to use our cover call ETFs, and they're finding that they're working very well for their clients and portfolios. So just maintaining that asset base and being the leader in this space in Canada for option-based ETF strategies, I think it's just another testament point to how strong the strategies are. And our ETF suite in it as a whole we've really filled a lot of holes for different investors as they build out their income portfolios. And just the general approach that we're taking, like that dividend approach for many of them, the way we're writing calls in a sustainable manner. We're doing things in a way that we've been doing them for the last 10, 11, 12 years. And I think that kind of stability,
it works.
The stability really resonates with a lot of investors, especially income-oriented ones who want to preserve their portfolios because they can't have a surprise in their portfolio. They're relying on those income streams to fund their cost of living, and just understanding that there's not the added risk involved with adding leverage or things like that it is a little more of a sustainable approach. And then lastly, transparency, I think, is a really big one. We offer a ton of resources for investors. Our derivatives report is published every month, so you can actually see exactly where Chris and his team are writing their options every month on every single ETF, how far out of the money, what they're doing. So you can always stay up to speed as an investor and know exactly what that ETF is investing in. I don't know, Chris, if you want to add anything.
I think you got just about it. You know, I think you got everything there. But yeah, again, we're just trying to be very transparent, do things the right way, be sustainable. You know, we've talked about it, you know, over the course of the discussion, which has been great. And you know, we're not trying to fit a square peg into a round hole or anything like that. We're just, you know, trying to be very straightforward with what we're doing and give clients some products that are built to last.
For sure. And listen, guys, I really appreciate your time. I know there's a lot of things that you said that will resonate to the audience. You know, I love that Chris said, you know, we're not looking to give people bad experience with our product. You rarely hear that from a fund manager. Obviously, you guys are in tune with, you know, trying to keep as much stability and safety with these products, but also deliver that higher income. And, you know, like we saw with the technology one, you guys got some good strategies there for sure. So I really appreciate you guys coming on, sponsoring this interview and this video. And I will leave off by saying you guys also have a YouTube channel, which I've been a guest host a few times on there. So it's this one here, ETF Market Insights. And I have to say there's a recent video was this one here that you guys actually talk about covered call ETFs, covered call strategies. It's called Avoiding the Yield Trap. So I strongly suggest that one. And you guys are doing these every week. You have some guest hosts. You have my compadre, the other Adrian, influencer as well, who I met in Montreal, really cool guy. But I have to admit that the one I did still has the most views, I believe, at 112,000. I just had to say that, sorry. But yeah, cool resource. Danielle, you want to add anything about this channel and why
Thanks
people
for
should
highlighting
subscribe
it.
to it?
Yeah, it's our weekly show. Check it out. We talk all about ETFs for Canadian investors specifically. So beyond cover calls, but it's I think it's great educational resource.
Yeah, that's awesome. Yeah, the more education, the better. That's what I'm trying to do. I'm just trying, I focus on income investing, but I mean, it's you got to learn the different styles of investing, try to figure out what's best for you. So hopefully this was extremely valuable information for the audience. I think it was for me anyway. It was very, very informative. So once again, thanks guys, and hope to have you back again soon. Hopefully not in 2 years.
Less than 2 years, less than
not
2 years.
Yeah.
Yeah, great. Thanks for having us on, Adrian. Always fun.
Danielle, Chris, take care, guys. Bye-bye.
Thank you.
Bye.